Good day, everyone, and welcome to the Market View and Strategy Positioning presentation for the month of March 2023. So, let me start with what has happened in the last 1 year and in the last few months, how the market has reacted, which are the sectors which have worked, which are the market capitalization, and which are the strategies which have worked, and then move to what we expect in the future. So, in the last 1 year, uh, benchmark index, which is Nifty 50, has been flat, has seen a 5% move, while um, other developed markets, including US, represented through S&P 500 or Dow Jones Index or Nasdaq, and other emerging markets have seen a significant downtick. So, thus, in last 1 year, Indian markets have significantly outperformed other global markets. This is mainly due to the robust economic outlook for India, while other economies are facing higher probability of recession. In the last 1 year, again, mid caps have done as well as the large caps, while the small caps have marginally underperformed. In terms of investor mentality over the last 1 year, we have seen that Indian investors have shown a great deal of maturity in last 1 year. One of the biggest reasons why I say so is that uh, when the global markets were falling, the SIP flows in the Indian mutual funds continued, and Indian market did not witness the adverse panic reactions which we would have otherwise seen. On the sectorial front, in last 1 year, PSU banks, FMCG, auto, and private banks have done well, while in sectors like media, IT, metals, energy, and realty have been underperformers. Indian markets peaked in on 30th November 2022, post which there has been a significant correction in sectors like utilities, insurance, transport, agrochem, building material, oil and gas, telecom, discretionary consumer names. While sectors such as FMCG, which is consumer staples, IT, auto ancillaries have done well. Insurance too saw pressure because of the government announcement with regards to tax implications for premium over 5 lakh rupees. Um, and in terms of banking, the index has more or less fallen as much as the market. One important factor which led to the underperformance of Indian markets in the last few months is the pressure which Adani Group stocks felt after the report by Hindenburg. In terms of total market capitalization, Adani Group stocks have corrected more than 60%. This includes all the nine stocks of Adani Group which are listed, including ACC and Abuja. But what we've seen is since last 2-3 weeks, the broader markets have taken a breather, while the volatility in Adani Group stocks still continues. But after the second March, stock buying by one of the marquee foreign investors in Adani Group stocks, there is a semblance of stability which has also come back in Adani Group stocks, which bodes well for the broader markets, but also bodes well, especially for the banking sector, because that sector had also taken a significant hit because of Adani stocks being under pressure. Since January 22, we've seen a significant underperformance by small cap stocks versus Nifty 50, which represents the large cap universe. Uh, Mid cap stocks have more or less performed as well as the large cap universe. Since Jan 22, which is almost 14 months now, we've seen PSU stocks are doing significantly well versus other names, cyclicals or defensives. In fact, in PSUs, if you see, banks had done significantly better than other PSUs, but since the pressure on Adani Group in the last 1.5 months, PSU banks corrected significantly. while other PSUs were still very stable. Uh, Now, with some kind of semblance coming back in Adani Group stocks, we believe that PSU banks can do well going ahead. Now, if one looks at PSU performance over the last 20 plus years, then one would see that uh, PSUs which were earlier part, you know, at some point in time were almost 37% of the overall market capitalization, went down to almost 8% during COVID times. They've inched up to 12.5% now. We believe that there is still room because if one takes a 20-year average, then typically PSUs used to contribute close to 23% of the market overall market capitalization. So in the next year or so, we believe PSU banks, PSUs in the utilities and the railway space can do exceedingly well. Another sector where we've seen some kind of bottom formation and which may see recovery in the near term includes IT. In terms of valuation, this sector has seen valuations correcting from 32 times to 22 times, uh, which essentially is to do with expectation of slowdown in the developed markets, including US and Europe, which are the predominant markets for Indian IT companies. We believe that the slowdown more or less gets priced in at the current levels. One has to see what kind of loss in earning momentum these stocks or this sector looks at before taking any sizable bet on it. But we believe that in terms of valuations, we have more or less, reach a kind of stable level. Now, if one looks at the top 500 stocks, which are part of NSE 500, uh, after the recent correction in the market since 30th of November when the market peaked, you would see that uh, of the 500 stocks, uh, close to only 28 stocks are close to their 52-week high, while more than 165 stocks or 165 stocks are below at least 30% from the 52-week high. Now, this is still better than the data which was there on 23rd of December when the markets more or less made bottom, where only five stocks were close to 52-week high. So from five, we are now at 28 stocks which are close to 52-week high. But amongst PSU, none of the stocks currently are close to their 52-week high. In terms of market capitalization, if one looks at amongst large cap, 20% of the stocks are below 30% from their 52-week high, while almost 40% of small cap stocks, which is almost double in terms of percentage, almost 40% of small cap stocks are uh, more than 30% down from the 52-week high. So, in terms of broader market, since they have underperformed, now the broader market looks more attractive than earlier. If one looks at the stock performance in the last 1 month or 3 months, one clearly makes out that the fall was predominantly driven by Adani Group stocks, which have underperformed significantly on a 3 month and a 1 month basis. In 1 month basis, we've also seen pressure in metal stocks because the kind of up move which was expected post China opening up has not yet materialized. So this is a very interesting chart, and we include this chart every time during our presentation. This gives the broad market perspective in terms of how the broad market is performing. This chart gives amongst the NSE 500 universe what percentage of stocks are trading above their 200-day moving average. Uh, Historically, 53% of stocks trade above their 200-day moving average. Currently, this figure is at 42%, which means that the broader market has underperformed uh, if one compares historically. And thus, there is room now for the broader market to start performing uh, and reach historical average levels. Now, one of the reasons why the broader markets have not done that great, and we see lower than average stocks which are trading above 200-day moving average, is that retail participation took a dip, especially with the Adani saga. Now, with stability coming back in the markets, uh, from 51% average turnover by non-institutional players, um, we are now down to 46%. This, once it starts moving up the average, we will see small and mid caps doing better, because typically retail participation is far higher in small and mid cap stocks. In terms of strategies which have done well, or characteristics which have done well, you see that in the last 1 year, growth is clear outperformer, followed by value and quality, while momentum is a loser. If one comes back uh, to the short term, which is 1 month, 3 month, and 6 month, again, here value is done well. Quality and growth has also done um, average, but momentum again has been a big loser. So if you look at both our key strategies, Contra, which is a value and a momentum focused strategy, and growth, which is the growth and a quality focused strategy. We've tried to balance these parameters and come out with returns which are far better than the indices, which I'll be covering later on. So one factor which is a key concern and which has been an overhang for the Indian markets is FII or FPI money. Year till date, which is almost 2 months now, we've seen an outflow of $4.3 billion from FPIs. Um, so what we saw is in FY21, we saw a huge inflow from FPIs to the tune of $37 billion. Now in 22 and 23, of this $37 billion, $25 billion was pulled out by FPIs. The outflow still continues, but once Indian markets start, factor in decent valuations, we will see this. We'll see reversal of FPI money, and hopefully we start seeing positive FII inflows in India. But during this same period, if one looks at domestic institutional investors, they have been consistent investors in the Indian market. In fact, year till date, which is last 2 months, they have invested close to $6.4 billion in the Indian market. And since 1st Jan 2020, domestic institutional investors have invested close to $50 billion in the Indian market. One difference which one notices, and this is there in the bottom right corner chart, which is the consistency of foreign direct investments in India. And since FY 2021, 22, and and for financial year till date in 23, we have seen strong and consistent foreign direct investment inflows in India. This is typically the money which goes into setting up fresh capacity in India. So India is emerging as a destination to manufacture, destination to do business in, and this can be clearly be seen from the foreign direct investments which India is attracting. Now, just looking at various emerging markets. So as I covered earlier, India did well on a 1 year perspective, but since last few months, India is witnessing pressure from foreign institutional investors. December, Jan, Feb, all 3 months have seen uh, outflow from foreign institutional investors. A part of this money has gone to markets like Brazil, which are commodity producers, markets like Taiwan, South Korea, and possibly China, which were trading at a discount to the Indian market. Now, if one looks at the performance of various indices, so on the left hand side, we look at various sectorial performance in India, including market capitalization and sectorial performances. And on the right hand side, one looks at the various emerging and developed markets. So in a 1 year perspective, Indian markets have beaten most other major markets. But in the last 1, 3, and 6 months, Indian markets have underperformed other developing markets and especially developed markets. So there has been some kind of reallocation which has happened. Sectors which have done well in last 1 year include banks, uh, both private and PSU banks, FMCG, auto, um, and FMC and infra and capital goods. While sectors in last 1 year which have not done that great include pharma, realty, um, metals, and media. Now, if one looks at the 1 and 3 month perspective, also we've seen defensives like FMCG, like IT doing extremely well or outperforming the market, even though the absolute returns have been negative. But sectors like metal, pharma, media, real estate, services sector, and energy have seen significant drawdowns. Now, one area of concern for us is the valuation for India. So, we have an India valuation index which factors in 12-month forward P, 12-month forward price to book value, bond equity earnings yield ratio, and market cap to GDP ratio. And if we factor in all these four fundamental parameters, then Indian market is trading at almost one standard deviation over its historical mean, which means that these markets are trading at premium. See, a part of this premium is justified because Indian markets and Indian economy is expected to grow better than other emerging as well as developed markets. And since the growth will be higher than the competing markets, it's obvious that flows should get attracted to a market which is a lot more stable and which is showing earnings growth. Another positive reason why Indian market should trade at a premium over other markets is that the Indian banking sector is in a far better shape than the global banking stocks. So, which again would be a key driver for earnings as well as economic growth in India. So if one looks at not just this, but breaking up the parameters in terms of 12-month forward PE ratio, we are currently at 17.9 times 12-month forward PE ratio, which is almost one standard deviation over its long-term average. We are at 0.7 standard deviation over long-term average. While on a price to book ratio, we are better, but we are still higher than the mean. Again, if one looks at 12-month forward PE of FTSE India relative to other emerging markets, we are one standard deviation over the mean. In fact, on an average, Indian market has traded at 39% premium over other emerging markets. Currently, we are at 75%, so which is pretty high as compared to historical numbers. This premium was actually almost 110% uh, when the Chinese economy was getting hit by COVID-19, and the Chinese economy was under lockdown. In terms of sectors which are fairly valued, so if one looks at PSU banks, energy, metals, overall banking sector, auto, and media, we are more or less fairly valued, while sectors, and if one compares historical P multiples, then auto, IT, real estate, FMCG are trading at premium valuations than the 10-year averages. In terms of Nifty, again, it is trading at slightly higher valuation than its 10-year average. So Indian markets till FY21, uh, in terms of earnings growth, was a laggard. The earnings were growing at single digits. FY22 was a year where we saw significant increase in earnings, and this is followed by healthy earnings in FY23. 24 and 25. In terms of the result season, post Q3 FY23, which is the third quarter results, we've seen a marginal downgrade in Nifty earnings of less than 1%, while our earnings estimate for 24 have seen a marginal uptick. Sectors which surprised positively in this result season were financials, mainly banks, FMCG because of margin surprises, and automobile. While oil and gas, telecom, cement, and metals are the sectors which were a disappointment in terms of earnings versus their expectations. Just to summarize whatever I've mentioned till now, in the last 6 months, small and mid cap stocks have underperformed large cap stocks. In last 1 year, mid and large cap stocks have moved more or less in tandem, while small cap stocks have underperformed. This underperformance can get reversed if retail participation moves up, which is expected once the markets stabilize. Domestic consumption dependent sectors like banks, auto, and consumer FMCG names, have outperformed export driven sectors. Though PSUs of late have witnessed some correction, they have outperformed in the last 1 year. There is further room for PSUs to outperform in 2023, provided the markets stabilize again. And we are seeing signs of that happening right now. In terms of the market breadth, markets are now attractive as stocks above 200-day moving average are below its long-term average. Amongst investment styles, value, quality, and growth have done well in the last 6 months, while momentum has been a gross underperformer. Focus should be on stocks which are exhibiting quality and growth characteristics, but are available at reasonable valuation. And this is what we are striving to do in our strategies. From a valuation perspective, valuations for at the current level are still higher than its historical averages, but a part of this premium can be explained by better economic and earnings growth of Indian corporate versus other emerging as well as developed market economies. We believe that earnings have remained resilient in the first 9 months of this financial year with marginal downgrades, which lends credibility to our earnings estimate for FY24 and FY25. With Adani Group stocks now stabilizing, we expect broader markets and the PSU basket to perform better. And we advise investors to take advantage of any fall in the short run to increase their equity allocation for long-term wealth generation. With this, let me just move to the PMS strategies which we manage. So we follow a very active management philosophy for managing money. We start with looking at various high frequency economic indicators, various investment styles, market cap based indices performance. We keenly look at various volatility frameworks and sectorial performance, and also look at India Value Index, which is a proprietary developed index by Axis Securities, and then start allocating money and allocating capital to the PMS strategies. We shortlist stocks based on the top-down and bottom-up analysis, while also using factorial models, which are 5-member strong quantitative team researchers on. We also perform 8 accounting checks to minimize mistakes, because while investing, you're prone to make mistakes. The idea is to minimize the drawdowns from the mistakes and maximize the upside if you get the stock and the cycle right. For the shortlisted stocks, we do in-depth fundamental research analysis backed by Axis Securities research team, which is of more than 25 research analysts spread across fundamental, quantitative, and other research areas. Our portfolio typically consists of 20 stocks at all times, which gives us enough diversification benefits, but also provides for a sizable position in a single stock. A single stock concentration will never be significantly more than 10%. And we also run our quant model, which looks at correlation between various stocks to provide the best possible allocation from a diversification point of view. However, the quant correlation allocation model serves only as a guidance, and we do not strictly follow the allocation suggested by the model. Now, let me just quickly go through the portfolio and the performance. So, our pure growth portfolio has almost 51% of allocation in large cap, typically spread across financials and consumer and industrial names. In terms of performance, across all time frames 1, 3, 6, and 1 year, and 2 and since inception, this strategy has outperformed the index, which is BSE 200 after cost. Again, our pure contra portfolio, 60% of our allocation is to large cap. And again, across time frames, this strategy has done well and has beaten the benchmark after cost. Please note that the 2-year and since inception performance are on a CAGR basis. Apart from this, we also run retirement and conservative strategy. We run our ethical strategy, which is Sharia compliant. And for portfolios which are more than 5 crores, we can also run customization strategy. With this, I come to the end of my presentation and would thank each and every one of you to take the time out and listening to us. Thank you and have a good day.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.